Looks like we got a couple of people coming in. That's good.
Yeah, but maybe another minute or two here for folks to roll in.
Sure. So just for our waiting, if folks want to put maybe just who they are in the chat and any information where you're located and maybe some information or insights into your interests of passive investing, that'd be great. And while we're waiting, that'd be great if you guys want to share some info. Up to you.
Well, John, I'd say it's all aboard or going aboard at this point. And if they join late. Go ahead and kick this off and introduce John Rubino. John will be giving us a great presentation today on the part 2 of the passive real estate investing series on what to look at in terms of the team and the of course, I would say that probably the core heart and soul of any passive real estate investment will be the real estate sponsors themselves. And so John's going to talk to us today about what to look for in the real estate sponsor and what role they fulfill. John, you want to go ahead and take it away?
Sure. Everybody got my screen. Doug, you can see it. Dave,
Looks
if anybody
good.
Can't see, let us know. And like Doug said, we'll get started. We'll kind of recap part 1, which was really an overview of passive real estate investing, and then talking more about your team and who you want to have around you when you're venturing out and starting to take part in investing in real estate passively. So this will be part 2 of a 6-part series, and we'll kind of walk through each part of the series in a few slides here. So thanks for joining us today. We welcome your questions. If you want to throw them in the chat, feel free to stop us as we're going over information. And if you want to learn more about our company specifically, who we represent today, as well as our contact info, we'll have that on the last slide. But this is kind of an informal chat discussion on this part of the series, and we want all folks to feel like they can participate. So with that, we'll get started. There we go. Just a quick disclosure. Obviously, make sure you do your own homework if you're getting involved in passive real estate investing. If you have any trusted agents like attorneys, registered investment advisors, those in your network, some of the folks we talked about in part 1. But this just kind of lets you know that what we talk about today is general information, but one shoe does not fit all sizes here. So definitely want to do your own homework and make sure that, obviously use these techniques and some of these strategies. They'll be very helpful. But if you want, it's always good to get in touch with trusted advisors in your network. All right, here's our team. We had this slide up last time. And again, I know Maureen asked about it. We have part 1 of the series available both on Doug's YouTube page and I believe his LinkedIn page. You can also join as a member of our JID Investments LLC company page on LinkedIn, where we have, the first 2 parts will be on there, and then this one as well as the remaining 4 parts we have left. And then you can also view other things that we're doing inside of our business with JID Investments. So we kind of went over this last time. We'll just do a quick recap. The purpose of the webinar really is a way for us, Doug, Dave, myself, to share information, share some insights and experience from where we sit and from what we've done inside of passive real estate investing. And, we wanted to create this series to give back to our friends, family, colleagues, people we know, we do business with, and really to give folks an opportunity to learn more about passive real estate investing if they're interested in it, using it as another way to diversify investment opportunities for you. Typically, they're called alternative investments, other than the stock market, and more of your traditional type investments. And again, we just want to give you some information that would help you as you kind of embark in your journey to potentially start as a passive real estate investor. Passive real estate investing is what it is. It's passive. You're not directly active or involved in owning a property where you're, basically dealing with the operations management, all of the detail of the actual property. You're more of a silent partner, and you get to participate and take part in some fantastic returns. Risks a little bit higher depending on what you get into, whether it's a public passive real estate investment vehicle or a private passive real estate vehicle, like a private placement. But it's just another way for you to diversify and to get into real estate without the headaches and a lot of the day-to-day things that you would have to deal with as an active investor, as you potentially go to work each day or run your business, or if you're self-employed or retired, you get to still enjoy those portions of your day. Again, active and passive, I kind of laid out. An example of active real estate investing is you buy a single family home, you oversee the renovations, you may have some bank debt on there that you personally guarantee, so you're on the hook for the liability on the finance side. You're also taking ownership of a property to fix it up, and then maybe you're putting a tenant in there, so after you get it fixed up and you deal with the contract and the renovation, then you're bringing in an active tenant who's going to rent it from you. So then you take care of the property management. That's more active. Passive is, you're a limited partner on a joint venture opportunity with a sponsor that's building a 190 unit apartment complex. So it's, let's say, some mixed use retail space, and you're either going to get cash flow or you're going to get long-term capital gain profits on the back end. Indirect versus direct passive investing. Indirect would be something like a real estate investment trust, or something where you're doing it through a broker or someone that's got experience in that field that can help manage some of those accounts for you, just like a managed account. Whereas, indirect is, again, being part of like a syndication. Sometimes you'll hear that, but that's just basically a money raising vehicle that allows passive investors to come in, and the sponsors, developers, folks that are the active piece can pull those monies together to invest for you and as part of those investments. Okay. Benefits and risks, we talked about those. Won't go over those too much, but everything has risks. Everything has benefits. Passive real estate investing, the biggest risk really is that you can lose your money, which is always a risk. But the biggest benefit from that is you're not taking on a lot of the liability on the financing side. You're not taking on a lot of the direct day-to-day risks that you deal with, and you're a little bit less hands-on. So again, the biggest risk most of the time with passive real estate investing is you're going to be having your money out there, potentially could get a portion of it or all of it could be lost. But that's why you're going to do your homework, and we're going to help you kind of walk through some of those steps to help minimize that, so you get some great returns. And then again, passive real estate investing, you got to do your homework, kind of what we talk about, do some of your research. And, if you feel it's something that you're interested in, participate, take it on. It's definitely worth it. I've done it for 15 years and I've been very successful. And again, using a lot of these strategies and a lot of these techniques that I've learned. And that's kind of what we want to share with you guys today. So we'll kick it off. Dave or Doug, am I missing anything?
No, I think you covered it pretty well, John.
Okay.
Yeah, I concur.
Sounds good. Thank you, guys. So here's kind of the 6-part, or I should say 7-part, 7-part series. And again, last time I talked about our team. Today we're going to really focus on the real estate sponsors. There you go. And so we're going to talk a little bit about how to kind identify, locate, look at how the sponsors are and who they are and what they do and what makes them unique, what makes a good sponsor versus one that you may want to be careful of. And some of the things that, you want to be asking these sponsors as you get to know them. And we'll get into more of that when we first, when we start going through that. But next section or the next part we're going to cover is the location. And very, very important, I would say, very, very closely aligned to the sponsor is your location of where you want to go. So we'll talk more about that in part 3, maybe touch on it a little bit today. Then the types of real estate investments in part 4 is going to be really your asset class, what you're interested in as far as whether you want to be involved in investing in residential renovation properties. Do you want to invest in development or new construction? Do you want to invest in opportunity zones, storage, student housing? These are different types of asset classes that you have the opportunity to invest in. Part 5, we're going to talk about what's called the capital stack. How does the bank come in? Where does that money usually kind of, sit on this tier of top to bottom on the capital stack prioritization? Where do you go to get the money for a project? What should that look like when you're coming in on a deal? How does the leverage work? What's typical loan to cost versus loan to value? How does the other money come in? Where do the sponsors go to get that? So that's all really important information to know as you start looking at some projects and start looking at deals. Due diligence obviously is going to be probably the most comprehensive section we discuss, as well as part 7, the distribution schedule. Due diligence is really, we're talking about that now. We're going to talk about some due diligence today on how to look at sponsors and then the location, the project types, and the capital stack. But the due diligence is really when you're going to do your homework and dig deep into looking at a lot of these things that we talk on in these preceding sections. And, when you get to part 6 and you've got part 2 through part 5 really, nailed down, you kind of are getting to the point where you're really starting to get ready to potentially participate as a passive investor. So that's something to also kind of key in on. And then part 7, like we said, hey, I put my money in this great real estate investment as a passive investor. How do I get my money back? What do my returns look like? What's a preferred return? What's a waterfall? How does that work? What are profit splits? What's a catch up? Stuff like that. We'll kind of go through that in part 7 and make sure you kind of have an idea. So when you look at the way that's broken out, you kind of understand it. So today, like we said, we're going to focus on the sponsors, the developers. These are the folks that will have the project, and they're going to be taking this investment opportunity, this real estate project from start to finish. They're going to come in and they're going to be in charge of the financing. They're going to go out and get the financing. They're going to put the money together. They're going to get the general contractors put together. They're going to have all of the costs put together. They're going to have everything put together on the investment, on the project. And then when they come to you for the capital as a private investor or private passive investor, you're going to want to make sure that obviously they've done all this homework. And when you get into that due diligence section, we'll talk to you more about how to look into that and make sure that you kind of cross your T's and dot your I's. So just breaking out some subsections of this, the first thing, obviously, which probably is number 1 on the list, if you've already thought about it, is the experience of the sponsors, right? Now, it's not necessarily a bad thing to invest with a new developer or new sponsor. I would advise, given the challenges we're seeing in the economy today, most folks are really sticking with the more experienced sponsors and developers they've invested with before, who have a pretty solid track record. My kind of thing is, if I'm going to invest with a newer group or a group that's just starting out or has only got a few projects, I'm going to want to see better returns. I'm going to want to see more of that, profit come my way as an investor. But from an experience standpoint, you want to look at sponsors that have done, let's say a minimum of 12 projects, depending the size and the scope. They can walk you through, at least 3 of those or of the number of projects that they've finished, let's say over the last, 6 to 18 months. And they can give you insights into, how well the project went. How did they do from their projected returns, projected revenue, projected profits and costs to their actuals? So a lot of times I like to see like on a scorecard, hey, here's how we said we were going to do. Here's how we actually did. And make sure that those are closely aligned or they are better than they projected. And if they're not better, that's fine too. You also want them to be able to show you their best deals and their worst deals, and then walk you through, what happened on those deals they struggled with. Why did they not do as well? And a lot of times it could be, hey, COVID hit. We were projecting a home run and we hit a double. Here's some of the areas we learned about what we can kind of go back to as a lessons learned and to implement it to our practices and procedures. But you definitely want to have someone that's got, definitely strong experience, good balance sheet. They got good finances in place. They got a good team. Usually you'll have a group that has anywhere from, 4 to 10 to 15 to 100, just depends. The larger the group and the more institutionalized they are, which is really like a more, kind of set group, a set company, then typically the returns are not as potentially high as a group that maybe is a little less experienced. But at the same time, you've got to weigh that. You may want a group that's like, super, super, super experienced at the institutional level, and you're willing to take a little bit of a less return or a more moderate type of return than someone that's maybe not as experienced and is going to give you a larger amount of return. So these are all the things you would take into consideration. You want to make sure you also look at their team. Who's their go-to general contractor, who's their attorney, who's the architect, and they shouldn't be afraid to share the contact information of those groups. So that's something on my checklist we're always asking you. Who's the guys on your team? How many deals have you done together? Have you had any challenges or kind of, problems with them? And what are some of the things you learned? So that's kind of the experience one that I've kind of looked at. There's a couple more things in the weeds, but that's the big stuff. Doug or Dave, anything else to add on experience before we go to the next subsection?
Yeah, John, I'll just jump in real quick and add one kind of comment to the experience section. One of the things you really want to look at is not only the developer's overall experience, but the experience in a particular asset class in which you're planning to invest. For example, if you have a sponsor who is very, very experienced and for the last 10 or 15 years has been, building large self-storage units and then suddenly wants to jump into condos or apartments or a completely different asset class, that may be okay. But you'll always want to verify not only the experience, but the experience in a particular asset class in which you're planning to invest.
Yeah, Dave, that's a great point, and thanks for mentioning that. We've worked with sponsors, like Dave said, that have been multifamily centric and really focused and really good at multifamily, that want to get into, like, let's say assisted living or built to rent, and that's fine. But you want to make sure that somebody on the general partner team, the team that's part of that sponsorship, has got at least 10, 20 years of experience that they bring on with them, so that you've got best of both worlds. You got that developer who can do really well on the multifamily and bring that aspect of their experience to the table, but then they're also bringing in a general partner that is, an asset class focused and experienced part of that new asset class we're getting into. So we see that a lot. And that's actually a great thing to have, is where you got those two types of experiences coming in to partner in a specific or customized type asset class. So that's a great point. Thanks for sharing. Doug, anything from you? I'm going to continue.
Yeah, just along that same theory, though, along that same lines, my belief about this is arrogance, debt, and real estate probably aren't a good combination. So the willingness to be humble, even if you've developed a certain asset class for 10 years and you're going into a new class, very, very good sign if they bring in somebody who's already in that space to joint venture with. Joint ventures are for the win in this space. And so I look for a little dose of humility, I guess, in your GP is probably a good thing.
Yeah. Great point. One of the things I want to say too is, if you've got your list of things you're going to ask the sponsor, your last set of deals, how many have you done, the good and the bad, projected versus actual, what markets have you been in, putting this list together. And again, offline, Doug, Dave, and I are happy to sit down with anybody that wants to set up a call to go over more in particulars. Again, this is more of the overhead or wave top. If you ask for this information and they're reluctant to give it to you, or they come across like Doug said, a little bit arrogant, or they say, well, we don't normally share that information, that should bring a red flag up. Because if they're not willing to be transparent and give you the information that you feel comfortable with, Again, you don't want to have 1,000 things that you want to ask them, but the big things, the things that are important. If you feel like they're not, willing to share, they're giving you a hard time, or you sent an email and 24 hours, 48 goes by, 72 goes by, and they're not responding, that's a red flag. And you want to kind of keep track of that, because too many red flags means that you're not going to want to work with that group. So, you're not going to marry someone that you can get into arguments all the time with, as a boyfriend or girlfriend or whatever. You're not going to, say, oh, if we get married, everything will be fine. Yeah, that's not going to work. I speak from experience, been married for 21 years. And just something to think about, that if they're not willing to share that information, it's definitely a red flag. So the next one we're going to look at is key people. We talked about that a little bit, but who are some of the key people? You want to make sure you know who their lenders are, right? Who's going to bring in the money on the debt side. And the reason why is because usually the debt side is going to be the bulk of the money. Usually 50 to 70% of the total cost of a project is going to come from the bank, or it's going to come from a debt lender. Nowadays, with interest rates being high and with the banks really leveraging less capital, it's more towards that 50%, but they're still going to be bringing in a large share of that money. So you're definitely going to want to know, hey, you're willing to share who your financing piece is, who are they, how many deals have you done with them, who's their kind of key POC or point of contact. Another is, if they've got a larger institutional group that's going to be coming in for a big chunk of the equity, you may want to also ask who they are, how many deals have you done with together, can you give me some information? You should definitely get all the websites for these groups if they have them, and or contact information, and tell the sponsor, hey, if I feel I'd like to reach out, do you have any problems with that? Most of the time sponsors will say, no, I don't have a problem with that. But yeah, definitely the financing piece, the general contractors, and how many times have they worked together, the architects if they're doing new design or add-ons, engineer, lawyer, property management team, brokers. These are all the folks that are kind of part of that team for the sponsor that's going to help them get that project and walk it from cradle to grave. So very important. I usually ask for that, on my second or third conversation after having a couple of conversations with the sponsor, to know that, hey, I'm starting to do my due diligence on you. Can you please share some of your key folks and their contact info and websites? And then you could also go on LinkedIn. You can go on the website to see if there's anything that you need to check out, if there's a red flag about whether that person's got problems with finances, or if there's an issue with them on a recent project or a past project as well. Guys, anything else to add?
Listening to the webinar.
Oh, I'm sorry.
Hey, Robin, I think you're on go on mute there. Thanks. Hey guys, anything else on key people that we need to share, or anybody else I'm missing?
No, I think you covered it, John. Thanks.
Yeah. And folks, feel free to jump in if you got questions of anybody else, or if anything else you want to add, we're happy to share. So please do. I know there's been questions in the chat, so that's good. The next one's going to be performance. Obviously, they got the experience, they got the right people around them. Hey, how have you done? If you made money on most of your projects or not. So, if the performance is like it shows there in the green, then that's obviously a group that you can feel good about. If there's positive news press on them, if they share some press releases. A lot of these sponsors have really good websites that you can go to. They usually have blogs or press releases or news articles. And, you could definitely back yourself up by looking at that. But yeah, again, when you start getting into some of the information they're willing to share with you, and they show some of their recent or, their track record of projects, you could then get a good sense that, how well they've performed. And again, don't be afraid to ask, what was your worst project? Where did you struggle? Why did you struggle? What were some of the things you learned from it? How do you implementing some of those, processes or strategies or standardizations that you're doing now that have helped you get over that hump, that get over that challenge you have. So performance is obviously a big one. Go ahead,
John, I'd like to hop in there. I would love your advice on this, because essentially, back to the humility standpoint, if they're weird about sharing losses or sharing what they learned, or they've never lost money, unfortunately, you might be the first time. And again, I'd hate to hear that from someone who's like, oh, I've never lost money, and the way they answer it is really important. And again, maybe they haven't. They've had it. If fortunate, if they've had good luck, if you can. But even if they say it with a dose of humility, that's my theme for the day.
Yeah, it's a good point, Doug. I mean, you always want to share the good with the bad. I mean, you have to get into that mindset that this is objective. And, as an investor, this is your money and you're going to want to know, hey, tell us some of the things you struggled with. And I think every sponsor has had struggled with projects, whether it's weather delays, COVID, just labor force issues, inflation, supply chain issues. This project was supposed to finish in June and it went out 6 months and, delayed, but here's what happened. And here's how we kind of were able to still make a nice return for our investors. Here's how we kind of mitigated that risk of delays, stuff like that. And again, hey, this deal was supposed to make a 20% return on investment for our investors. And it made about 12 to 13. And here's where we struggled. Here's why we saw a little bit of a diluted return. We had to bring in some more debt. We're not a company that usually likes to have mandatory capital calls. We don't want to bother investors. So we brought in some member loans, which diluted a little bit of your ownership percentage. And as a result, instead of making 20, you made 17 or 18. Stuff like that. You want to ask that. You want to make sure that you kind of go through that when they kind of show you some of the good and the bad. And then if it's, hey, we performed as we said, or better, why did you perform better? Well, we were able to get a better loan. Our leverage was a lot higher. So that allowed us to get a lot more cheaper money and not have to go out and get as much equity, which is more expensive money. Or we were able to reduce our interest reserve, or we were able to kind of reduce some expenses, or we were able to take away some of our fees. We weren't as high on our fees, which we'll talk about in a second. So these are all the things you want to have in your back pocket. And again, as you're learning to do this, again, you'll learn this over time. And in part one, we talked about growing your education. These are some of the things you'll ask. But yeah, that's kind of some of the things you want to connect the dots on when you start talking about the performance for these sponsors. And again, I mean, as you say, I want to look at 2 to 3 to 4 deals, the minimum, if I'm going to work with a new sponsor and have them walk me through it. They give me the time, they give me their time, they give me their effort in walking me through. If I have questions, I put together, my team and I put together a pretty detailed list of questions when we initially look at some of those first level projects. We don't even look at a deal 90% of the time before we start working with a new sponsor. We want to build that relationship again, get all of that stuff that's prerequisites and out of the way before we start looking at live deals. And we kind of lay that out in the beginning. Say, hey, don't come to us if you got a deal that needs to be funded in the next 30 days or 45 days. We're not going to do it. I mean, unless it's, ridiculous returns and you guys have been around for a while, we can accelerate the process, but 99% of the time, we're not going to do that. So financials are very important. Obviously, is this a company that's losing money? What's their balance sheet look like? Big picture. If they're willing to offer you their balance sheet for the personal that they're going to be guaranteeing the loans, that's great. You can see what their balance sheet looks like. But yeah, I mean, these are some of the things you should be looking at. Do the numbers make sense when you look at the financials on some of their projects? You can call down to some of the markets that they're in, talk to some of the general contractors down there, and just, kind of get some insights. Hey, I'm getting ready to invest in this market. Might look at some of these projects, and I'm looking at doing some projects down there myself. What are you guys seeing price per square foot on lumber? And you can even go online and pull a lot of that stuff up just to make sure that you kind of see that the numbers make sense on the financials. But that's very important. Obviously, you don't want to be working with a company that's got a knack for losing money, has operating in the red, and are struggling with their financials. So very important to look for that. And make sure too, they're willing to share things like their project performance and see how, rents are looking, are rents jumping 20% a year on these deals that they're doing, and why? And are they underwriting a 20% rent growth a year? That's kind of a red flag. Is their net operating income not taking into consideration their mortgage, and why not? So these are all the things you should be looking at and pulling up and asking about. I'm going to keep going here. So the next one's a pretty big one, references. A lot of the things you'll ask for when you talk to their key people. is the contact information. But what I mean by references is I would want to talk to some of the folks that have invested with these guys before, or these gals before, willing to give them contact information. Hey, can I reach out to 3 or 4 of your, your passive investors as a reference so that they know, and don't feel like, you can't do that. They should be able to share that with you if you want to talk to them. Some of the folks that join us as new investors in our company have asked us before, hey, can I talk to 2 to 3 of your investors? Absolutely. Yeah, I'll be happy to. I mean, and obviously I go out to those folks, let them know they'd be calling and say, hey, feel free. If I pissed you off before, tell them that too. So that hasn't happened yet. Thank God. I'm knocking on wood. But yeah, definitely ask about references. As for people that you can reach out to and talk to about them. And, ask them, walk me through a few of the deals you've been on. How was the payments? Were they distributing money as they said they would? And did you feel comfortable with them? And, any feedback? Sometimes online on Google, there'll be some ratings, or on a Facebook page, if they have one, there'll be some reviews. And sometimes people will share on that as well. Yeah, I definitely would say at a minimum 2 to 3 references to reach out to. So guys, anything on that?
No, nothing from my end, John.
Okay. All right, we'll keep going. Skin in the game. You probably heard this term before, but basically it's putting your money where your mouth is. Sponsors and developers should be bringing in their own money. Whenever my company does a deal, my business partner and I are always bringing money. We're always bringing money as a team. We're putting our money where our mouth is. Typically what we like to see is 7 to 10% of the amount of equity we're bringing into a project, or 7 to 10% of the overall equity if we're part of that is important. A lot of times what you'll see sponsors do, and this is their way of being tricky, and it's not necessarily an anomaly, but sometimes what you'll see the sponsors do is they say, yeah, I'm going to roll my fee into the deal, meaning they're going to get paid a fee, right? And we'll talk about it in a second. And what they're saying is, yeah, the fee I'm going to get paid by either bringing in your capital and or the fee I'm going to get paid as part of the operating expenses or the expenses on the project. I'm going to take that fee and I'm going to roll it into the project. I don't like that, and I'll tell you why. Because that's not really money they've got in their pocket. That's money they're expecting. So I like to see them say, no, I'm bringing in 10% of my capital. Here's what I'm bringing in. And it can be them, it could be their executives, it could be people in their network, but I want to see the developer, the general partnership piece of the membership, the ownership, and your operating agreement should have 7 to 10% of the equity that you're bringing in, or the overall equity that's coming in. That's what I want to see. And that again tells you that they're willing to put their money where their mouth is. Very important. Pretty clear cut. Fees are important for a couple of reasons. Fees are not a bad thing, because fees are ways people kind of take care of family. They pay themselves part of their payroll for their employees that are working in their business. But you've got to get an idea of what a high fee is and what a low fee, or what a high fee is really. Typically industry standards, depending on what type of fee it is, you'll see a construction management fee, an asset management fee, a yearly fee that covers expenses. It's usually broken out on a pro forma. And a pro forma basically is a model of the entire project, walking it from cost, rent rolls, sources of funding, how everything works from the project all the way through. It's usually on an Excel spreadsheet, a couple of tabs. And when you go to like a sources tab or a funding tab or financing tab, you'll see those fees broken out. And construction management fees usually around 2-3% is pretty average. Asset management fees around 1 to 2%. Property management fee can range from anywhere from 5, maybe up towards 8-10%. Just depends how big of a property is, who's the group. Are they managing, hundreds and hundreds of doors or apartments? So those are the things you want to look at. And yeah, you kind of take into consideration too, that if this person's making, let's say it's a I don't know, $20 million project, and let's say you're bringing in money that's making up about $6 million of equity. Let's say the other 14 is in debt, and let's say of that $6 million of equity, on day one they're getting a check for $500,000. Well, that's a lot of money. My question is, all right, why is that going to you on day one? Why can't that be maybe broken out over a 5-year period where you're getting 100,000 a year or 75,000 a year? Now, if they've got a big staff and they've got a high overhead, okay. But if I see $500,000 in year one and $500,000 in two, and it's like, whoa, hang on. How does that measure up against my returns? Is that really putting a dent in your cost to then impact my profits and my revenue? So you definitely should ask those questions. But like I said, industry standards on asset management fee about 1 to 2%, construction management about 2 to 3%, property management I would say anywhere from 5 to 7 or 8%. So that's typically what we're seeing.
Yeah,
Any
hey, John,
questions?
I'll just jump
Yeah, go
in
ahead.
real quick here, just to
Sure.
not to state the obvious, but to make sure everyone is on the same page.
I'm on the phone.
These are not fees that you as an investor will pay to a sponsor or to anyone else. Fees that John's talking about are fees that are either paid to the sponsor or paid by the sponsor to someone else. You as an investor should never pay anyone a fee to passively invest in real estate, whether it's directly to the sponsor or whether you do it through a company like BID Investments. We don't charge our investors any money at all to invest on their behalf, to manage their money, manage their investments on their behalf. So just to be clear, these are fees that are paid to or from the sponsor, not fees that you as an investor would be responsible for.
Yeah, that's a great point, Dave. I mean, these are already what we call baked in fees that are part of the project cost, but not at the expense of the investor's returns, the waterfall, the distribution schedule. So everything's independent of that. You as an investor are going to make your returns, but they're not going to be gross the fees paid to the sponsor, which is then the net of your profit net. These are independent of your waterfall and your distribution schedule. And if you're using, let's say, I know Mike Torrey's on, like a registered investment advisor, or you've got a managed account, or you're using a group to help you find these deals and place your capital, there may be a fee in there that your broker will assess to you, but that's on a case-by-case basis. That's not an actual fee that you would pay on the deal. There are other fees that David mentioned. There are broker fees, there are bank fees, there are all these fees that are in there, but again, they're not assessed directly to you as the investor. They're just part of the project fee. Okay. But if there's a fee on there that you're not sure of, or if there's a fee on there that you feel is kind of out of the ordinary that you want to ask about, by all means ask, because that cost could be something that impacts your returns at the end. So definitely ask about that, but it's not a direct cost to you as the investor.
And John, I was just about to ask you, what's the most outrageous acquisition fee you've ever seen?
Yeah, I think, like I said, Doug, I think I've seen some fees where, the sponsor is getting over $1 million, and it wasn't really something that I was like, shocked about, but it was definitely something I wanted to ask about. And when he walked me through it, and I understood it, and I understood how it was being paid, it made sense. And acquisition fees are funny because, again, I don't like seeing a sponsor get this huge chunk of money on day one, because in a way it kind of tells me, all right, like, is this guy still going to bust his butt to make sure that I get my profits? And if you go through the experience, if you go through all the key people and you talk to references and you look at other deals that they've done and those numbers are about the same, then okay, they've had success, even though they charge a higher acquisition fee. And maybe the other fees that are in there as well that they may get paid and more on a stabilized schedule is not as high. It's a lot lower. Maybe it's 0.5% or 1%. So maybe they kind of just manage it differently. But yeah, I've seen that before. It kind of, it's a little bit of definitely a question to ask, especially if it's a first or second deal with that sponsor. All right, getting close here. Time is good. So yeah, this is probably the most important thing you want to know about after you get through these other things that you go through is, hey, how do I, well, first for our company, the first thing we would tell you is how we protect your money, right? I can tell you you're going to make 1,000% return, which sounds amazing. But if I can't explain to you how I'm going to protect your money, then you should be very concerned, even if I tell you you're making 1,000% return. So always make sure that the sponsors can tell you how they're going to protect your money, and not just one way of protecting your money, but what happens if this happens, or what happens if this happens, or hey, what if the market drops by 30%? What happens if interest rates go up 8% to 8 or 9%? How does my money get protected? How are you going to make sure that if the worst thing in the world happens, I'm still going to get my money back? And so the sponsor should be able to walk through that with you. And if they can't, or they don't give you an answer that's satisfactory to your desires, then that's a red flag. All right. So definitely ask about that. And then, as far as your returns, you want to be able to understand, after I get my money back, or, how do I get paid? How do I receive, my returns on this investment? So I'm just going to talk about this very briefly. Then we'll get into this more when we do the waterfall and the distribution schedule in part 7. But a typical waterfall or distribution schedule you'll see is your money is going to get paid an interest rate or preferred return. And so that interest rate or preferred return usually ranges around 6 to 12%. Just depends how risky the project is. And basically, it's the sponsor's way of saying, hey, this is what I'm going to be paying you, or I'm going to be paying you as a deferral, meaning once money starts coming in, I'm going to start paying you this return per year. And that's going to be based on the amount of money you have in the deal. And that percentage is based on what you're going to get. So if you put in 100 grand and you're told you're going to get 8% a year, non-compounded, and it's a 4-year project, the first 32% of that 4-year project, or $32,000, is going to go to you as the investor, or part of that is going to go to you as the investor. And then after that, you want to get your money back. So what we like to see is the preferred return, your return on capital. And then at that point, we usually allow the sponsor to take their kind of first tier of return, which is what we call catch up. And basically the catch up is, hey, I've paid you this preferred return now, and I got you your money back. I've done my job on that first part. Now I get to get my catch up based on what you've got paid on your preferred return. And again, we'll show you those numbers when we do that last part. But that makes sense, right? They did what they said they were going to do. They gave me my preferred return. They gave me my money back. They're allowed to get a tier of return. And then after that, it's, hey, there's more profit left, which we want. How does that profit get distributed to the investor and the sponsors? So sometimes you'll see layers or tiers below that where the sponsor says, okay, we're going to give you a 80-20% split on the profits, pro rata, which is in your favor at 80-20 to the investor, until you get a 15% return. And then once we get to a 15% return, we're going to relax that and make it 70-30 in your favor, then 50, all the way down. Sometimes it gets really complicated. So you really want to sit down and go through that to make sure you understand it. Also, what makes it more fun and better for you is when you start looking at compounded returns. And compounded returns is, obviously your money's compounding year over year. So if you're getting, let's say, an 8% compounded return on your preferred return, and you don't get paid any money in year 1, then that 8% with the money in gets compounded in year 2. So you should see a higher return. So these are all the things you want to take into consideration. At the end of the day, for our company, we make it pretty simple. You get a preferred return, get your money back, we get our catch up, and then we usually split profits, usually 60-40, 70-30 in the investor's favor. That's it. So what we try to do is we try to get you about a 12% preferred return on our development deals. And then after we get our catch up and you get your money back, then we usually do a 60-40 or 74-30 split. You're getting about a 15 to 20% return overall with your preferred return and your profit split. So we'll talk more about that. And I know there's going to be questions, but just be aware that some sponsors get really in the weeds. And they could tell you till they're blue in the face or make you feel good about it and what they say on emails and everything. But the most important thing you want to see these stuff in is these legal documents. You want to see the operating agreements. You want to see a subscription agreement. You want to see any type of document that kind of walks you through the legality of the deal. And we had Dan Lyon on last time. He's a business attorney. First couple of deals with a new sponsor or a sponsor that you haven't worked with before, you may want to have your business attorney go through just to make sure you're protected. And that's the time when you go back and look at your emails to say, okay, did the emails match what it says in the legal documents? The email said no mandatory capital calls, but I'm reading here that if the sponsor needs more money, he has the right to come back to me and I have to bring in more money. That's a mandatory capital call. Wait a minute, that doesn't make sense. So these are the things you want to look at. You want to look at things like the time, how taxes get paid out. Like, when can I expect to get a K1? How does that look? Is there withholdings? No withholdings? That's a good thing to talk to your accountant about. Should I get some depreciation loss? You know, these are all the things that should be in that operating agreement and in those legal documents. And again, you know, when you're up here in the experience piece, the subsection, that's some of the stuff you want to ask for. Hey, can I take a look at some of your subscription agreements or how you do your operating agreements? Can you walk me through that? You know, they should be able to provide that to you at a minimum, provide it to you. So that's it for part part two, and this should actually say ready for part three. I apologize. That should say part three. So we're going to be going up to the next one will be part three. And with that, we will open the floor for questions. And we will, if you got any questions about the next part, I apologize for that. It should say part three. Okay, there we go. So part three will be next, and that will be our discussion on location. So with that, we're going to open the floor for any questions. And here's our contact information for Dave and I at JID Investments and Doug's as well. So feel free to reach out to us at any time. And on the bottom there, we've got a couple of our projects that are finishing up or finished and on the market right now for either lease up and or sale of the properties. Any questions, please feel free, fire away. I'm looking in the chat. Yes, good question. I think it was a good point to raise that Robin mentioned that, you know, usually, well, you're going to have the bank's always going to get paid first. They're going to getting paid interest, and the interest that the bank gets paid is going to be a lot less, even though I know it feels like a lot more right now than what the equity is going to get paid. So the bank gets the property, right? They get first lien position. They're basically going to take over the property if the sponsor cannot make mortgage payments or they fall through or the market shifts and they need to get the property owned and they need to take ownership. That's the bank's, you know, the bank can do that. Bank's going to be getting paid interest every month, regardless of whether or not it's a development deal or it's a cash flowing multifamily hold. And the bank's going to get their money back first. So biggest pot of money, the bank, lowest interest rate or lowest returns bank, control of the property bank, first one that gets taken out of the deal bank. So that's pretty straightforward. Then you get into either institutional equity, which is usually called preferred equity or mezzanine financing. They're usually batting second. Their returns are a little higher, usually 12 to 15%. And I'm getting into the capital stack, but might as well. 12 to 15%. They're batting second. They usually get back their money and their kind of fixed return year over year. They're off the books, and then whatever's left would be for the general equity, and the sponsors promote based on the waterfall breakdown distribution schedule. So good point, Robin. Thanks for mentioning that. That's a good question or a good point. Who else? Come on. I know there's other questions out there that we could help answer or share. If anybody's got any experiences that they've seen out there as of late, anybody have any questions about where the market's going? I have my crystal ball out. It's kind of cloudy, but I'll do my best to answer. I'm hearing a lot of crickets. Anybody going once? Well, I will just say what we're seeing now in the market, and I'm sure you folks are seeing it as well, especially if you're investing in IRAs. And, you know, it's definitely a challenging period we're in. And, you know, I think that we'll probably see another 1 or 2 potential rate hikes this year. Right now, deals are seeing interest rates anywhere from mid-7s to, I'd say, mid-9%, which is insane because this time last year we're at 3 to 4%. And, you know, they're getting less leveraged debt, which means basically they're not getting as much money. So they're getting less money, more expensive money. And then they've got to go out and get the rest of the money from the most expensive source, which is equity. So deals are getting very, very difficult to underwrite from a financing standpoint. And I think that that's going to continue probably for the next, 6 months to potentially the end of the year, because there'll be a lot of lag from that, even if rates stabilize or we even see rates come down, which I don't think we will, to hit that 2 to 2.5% inflation benchmark percentage, CPI. Let's see another question come in. Market corrections. Can you kind of amplify a bit more on that, Maureen? Like what in particular? Feel free to jump in and chat with us. I don't know if Maureen's
I'm just
talking.
thinking in general, John, thank you for your presentation. It was
Yeah, you're welcome.
excellent.
My pleasure.
I learned a lot. I'm been a
Good.
real estate broker, investor, private financier, and exchanger for many decades. And I like the idea of passive investing because it's not as much work as what I'm used to with my clients in real estate. But I've just recently felt that there's a shift in the marketplace, aside from what happened with the rates starting, and I don't think they're finished yet, as they're saying. And I just wanted to know how you can kind of guide us through the next year or two with your predictions in passive investing in real estate development.
Yeah, well, I mean, I could just tell you what I've done and what I've seen. I've been investing passively for about 15 years, and I got in right before the 08 debacle, and I was still active duty Navy, so I was still involved in opportunities that were doing pretty well, because there wasn't a lot of people that could go out and buy property cash. They needed help and no banks were lending. So if you had cash was king in 08 to about 2010. And I think that cash is king again. It's just that cash is cheaper. It doesn't, it's not as much value because of inflation. It's just it's an interesting time. I just think that there's, like Doug and I were talking, I think you were on, like, a lot of private equity groups are now standing up debt funds, and they're willing to take less of a return to have control of the property and make a 6 to 7% return. And what's nice about that is with these debt funds, they're usually made up of, wealthy individuals or higher end pension funds that are coming in, and they're not under the same restrictions and parameters and strict regulations in a way that it's very difficult for banks. So they've got a little more freedom based on their requirements and the parameters of their fund. But a lot of folks are going that route because, debt's making money. Banks aren't lending. So if the banks aren't lending, then who's going to provide the debt? That's where these groups come in, these debt funds. It was interesting because the end of last year, and I know I'm going back and you want to go forward, but I just want to set the stage. Going into last year, third, fourth quarter, when the interest rates started to take off, a lot of the larger lenders were not lending, right? And going into first quarter of this year, same thing. So what ended up happening was a lot of the regional banks and the smaller banks were coming in to take up that space, especially for, let's say, when I say CapEx, it's total project costs, let's say between 20 to 80 million or $50 million of total cost. Those smaller end lenders were coming in. So like where I live here in Virginia, Sandy Spring Bank, and a lot of these local regional banks were coming in. Then all of a sudden what happened? SVB fails, Signature fails, Republic fails, right? So now these smaller banks are failing, and Chase is coming in and Wells Fargo is coming in to buy up that debt to now take over these balance sheets. So now they're killing those smaller banks that were taking up more of that market share. So I think that, I'm not a conspiracy theorist, but I kind of saying to myself, why did these big banks all come in and swoop in? And now it makes sense, because they don't want those guys taking up any of that market share. So now going into second and third quarter, we're kind of like, this year is going to kind of be stabilized. I think that we're going to still see interest rates go up. I think Americans are starting to adjust to the fact that things cost more money, and we just got to try to deal with it as best as we can. Cut other areas, maybe less vacations, whatever. I don't want to get into that, but I think that there's opportunity, but you got to be very cautious in your numbers. You want to be very conservative with your underwriting when you look at deals. And a lot of loans are going to be maturing this year. So, there's going to be huge discounts because who's got to get paid first? The bank. And these sponsors don't want to lose, they don't want to lose everything and then personally be liable. So they're going to start selling these projects at a discount. If there's a $30 million loan, they're going to sell it for $34 million. And the equity is going to take the brunt. The equity may get lost. There may be very little left to disperse to the equity, but the bank's going to get paid back and these guys are going to get out of these tough deals. So when you got a deal that maybe is valued at, let's say, $55 million and there's $30 million into it, but the $55 million is based, let's say, on a 5 cap or a 4.5 cap. And now it's like a 7 or 8 cap, then you're kind of, pardon my French, screwed because you can't then at that point try to sell it for that amount. And you got your loan due. And so you just want to get out of that deal so that you don't default, lose everything. So there's opportunity there because now you can buy that property for 35, 36 million instead of 55 million. So there's acquisition opportunity.
Yeah, I'm starting to see that here actually in Southern California in commercial as well as residential, but more so in I like the space that I like is flex space industrial. That's my favorite, and vacant land. And I'm starting to see some substantial price drops.
Yeah. Well, industrial was doing great for a while, and now it's kind of stabilized a bit. Amazon just sold a ton of warehouses, and a lot of the big folks are getting out of that storage and inventory business. I still think that there's a need for market specific because you got these large scale home builders that are ordering product for appliances and materials way in advance because of supply chain challenges, and they want to lock in on prices. So where are they putting all of this stuff? They're putting it in warehouses so that when the time comes, it's available. So that's great, And one of the things, I'm jumping ahead to location, you really got to look at the location. The location is huge. I mean, we're on the East Coast, nothing against West Coast, but we're on the East Coast. We love the Carolinas. We love DC, Maryland, Virginia, Florida, Tennessee, Georgia, because everybody's moving there. Cost of living is pretty manageable. Weather's fantastic. If you look at where the major businesses are headquartered right now, Atlanta, Charlotte, we love Charleston. Charleston's a fantastic market. There's a lot of growth being in Charleston. So, if you ever want to get on a call with myself, Dave, or Doug, it's going to cost you that much. And we're happy to talk to you more in detail. But I definitely think that location is very important. Some people don't like to invest outside of where they live, and that's fine. But, if you hook up with a very strong sponsor, and let's say for you, Maureen, being in California, let's say in Charlotte, North Carolina, and you're passively investing, you don't have to jump on a flight every 2 weeks to go see if the GC is there and is he doing his job, It makes it a lot easier when you get a quarterly report showing you the milestones, what's been completed, pictures, maybe a satellite shot. We get a lot of satellite shots of our projects, like real time, which is unbelievable. And, we get these types of pictures you see on your screen, drone shots and stuff. So that's really cool to share that with our investors.
I love it. I didn't hear Texas on that list.
Yeah, Texas is a great state too. We started looking into Texas, but we really like the East Coast right now. But Texas is a strong market. Austin and Houston are getting a little bit saturated.